Greetings, guys. Welcome to the Wealth for Real YouTube channel. I'm your host, Christopher Anastasio, and today is Friday, October 20th, 2023. Welcome back, guys. Today's video, I'm going to talk to you about the subject of herding, Herding, when it comes to investment managers, when it comes to, people on Wall Street, hedge funds, mutual funds, whatever the case may be, who fall victim to or are subject to this phenomenon known as herding. And I specifically want to talk to you about it and highlight it for you in the Raghuram Rajan paper from 2005, title, I'm going to switch my screen here so hopefully you guys keep up with this. Has Financial Development Made the World Riskier? Again, by Raghuram Rajan. And, guys, this paper, just to give you a little bit of background on it, was something I came across all the way back in April when I watched the documentary Inside Job, the one narrated by Matt Damon that came out in 2010. So what's that, 13 years ago, and was in response to the Great Recession of 2008, the housing market collapse, the whole thing, the stock market collapse. And great documentary. I actually had very low expectations for it. I think I couldn't find anything else to watch. I just sort of threw it on the television early April and ended up loving it. I thought it was really well done in terms of sort of wrapping the story up into a concise way for most people to digest. Now, over a decade later, would be particularly useful since many of the details have been forgotten since then. Now, in the movie, Raghuram Rajan, I believe he was interviewed on camera at least once. Maybe he made a few appearances, but they absolutely mentioned this paper that I'm going to show you and walk you guys through a couple sections in. And it was that movie that made me want to read the paper, and eventually got around, I think over the summertime, to downloading it and kind of combing through it. And I've definitely made some other videos about it. If you guys have seen all my other stuff, you've seen me mention this paper at least, I believe, in 2 other videos. But what I'm trying to do is zero in on certain parts of it now and just focus on those parts. I think the very first video I made, I just sort of did a once over and kind of went through the whole thing and showed you guys why it was worth reading it in general. So let me kind of cut right to the chase on that, guys. I'm gonna switch over. Okay. So let's start off. Let me go over to page 6 here. So right here, guys, if you look at, he's giving sort of an introduction here. I'm actually going to kind of go up here a bit. Just sort of introducing the paper and what he's going to talk about and stuff. And so his first mention of the herd effect, HERD, is here. He talks about, quote, a second form of perverse behavior. And he's talking about the behavior of investment managers, okay, specifically. It's not the only thing he addresses in this paper, but that's kind of what he's talking about here. The second form of perverse behavior is the incentive to herd with other investment managers on investment choices, because herding provides insurance the manager will not underperform his peers. Herd behavior can move asset prices away from fundamentals. So this is the kind of, you guys might have been asking yourselves, like, why is Chris even making a video about this? Like, what does this matter? This kind of gets to the heart, guys, of one of my obsessions, which you've probably seen in other content if you've been following me, of why everybody, and this is a whole other separate thing, I'm not going to go too deep down this rabbit hole, but why everybody as an individual who cares about their finances, their portfolio, their future, financially, whatever, you almost have to be your own family office, okay? A family office kind of takes care of everything for wealthy individuals. Of course, that makes them inaccessible to most of us, right? It makes it inaccessible to me. I'm not a wealthy individual, so I cannot hire a family office. They would have nothing to do with my tiny little portfolio. But they cover all kinds of different areas of an individual's financial situation, from stock investments to real estate to art holdings to oil and gas, depletion efforts, things like that. So these are situations where when I talk about why this paper is important, is that when it comes to your stock investments, in particular, your paper assets, your equities, bond holdings, whatever, is that when you turn it over to somebody, like most of us, where you don't have the time or the expertise or both to do it on your own, you turn it over to an investment manager, right? Turn it over to a mutual fund manager or a portfolio manager at Fidelity or whatever. If you have to do that, and I'm not criticizing anybody who does it, I think that becoming your own family office as an alternative is not highly realistic for most people. But when you're forced to, or when it's the best decision for you to turn it over to somebody, you should be aware of this concept that I'm talking to you guys about now. The concept that whoever takes control of that portfolio more than likely is going to be subject to and fall victim to the herd effect. Okay, they're not going to be doing anything special or fringe or outside the bell curve for your stuff. Much more than likely, they are going to herd with other investment managers, and you're going to see why it protects them here in a moment. So that was the first thing I wanted to kind of mention to you guys there. Here we go. Both behaviors, talking about one before this and the herd behavior, or the herding behavior. They reinforce each other during an asset price boom when investment managers are willing to bear the low probability tail risk that asset prices will revert to fundamentals abruptly. And the knowledge that many of their peers are herding on this risk gives them comfort that they will not underperform significantly if boom turns to bust. Okay. Now let's talk about right here. Emphasis on relative performance evaluation and compensation creates further perverse incentives. Since additional risks will generally imply higher returns, managers may take risks that are typically not in their comparison benchmark and hidden from investors so as to generate higher returns. While choosing more observable investments within the benchmark, however, they typically will be wary of being too different from their peers, for they insure themselves against relative underperformance when they herd. Okay, so let's take a look at what he's talking about here. This is the heart of it, guys. In fact, if you were only going to read like one page of this and you were interested in this concept of herding, I'd go right here. You can see it's page 24 in the PDF, and it's page 21 in the document. So look at what he talks about here on herding. Established fund managers who are evaluated against a common benchmark like S&P 500 have an incentive to buy the stocks included in the index as a form of insurance, since only severe underperformance triggers dismissal. Even if they suspect the stocks are overvalued, they know they will be excused if they perform very poorly when their benchmark performs poorly. It's like, hey, S&P 500 did bad, so did I, right? It says here, would a few enterprising managers not want to buck the trend and thus return prices to fundamentals? Few would want to go up against the enormous mass of managers pursuing the trend. The reason is that their horizon is limited. If mispricing in stocks does not correct itself in a relatively short while, the investment manager will see an erosion of his customers as he underperforms. They won't wait it out. They won't wait until the end to see if he's right. It takes a very brave investment manager with infinitely patient investors to fight the trend, even if the trend is a deviation from fundamental value. Okay, increasingly, finance academics are coming to the conclusion that prolonged deviations from fundamental value are possible because relatively few resources will be deployed to fight the herd. So what he's talking about here, guys, this is important. There's sort of a macro and a micro. At the micro, he's telling you why your investment manager isn't going to do anything different from any other manager, right? They're going to herd with everybody else. So if they underperform, they're protected. At a macro level, he's taking the herding concept and showing you how it can impact the larger market, right? If everybody's herding this way or that to protect themselves in the micro, there's a macro effect to that. There's a macro possibility that that's going to move markets too far away from fundamentals and ultimately cause blowups. To summarize, overall incentives to take risk have increased. In addition, however, incentives to take tail risk, as well as incentives to herd and move prices away from fundamentals, have also increased. Okay, so he talks about that as well there in the conclusion. Now he goes on. Let me see here, guys. That's the part that we just read. And then I think the last one. Okay, so actually, before I leave this section, this is what I meant about the macro effect. If herd behavior moves asset prices away from fundamentals, the likelihood of large realignments, precisely the kind that trigger tail losses, very big, outsized black swan type losses, increases. Okay, so again, herd behavior moves asset prices away from fundamentals and causes tail losses to increase, or the possibility of tail losses to increase. Let me go to, so then there's a mention of it here. Do investors have the incentive or ability to restrain managers, restraining risk-taking? Similarly, because issuers, such as emerging market politicians, may also be myopic and may not fully internalize costs of accepting hot money, investors may not bear the full cost of the real damage inflicted as their investment managers herd in and out of investments. So that's kind of a throwaway comment to it, based on some of the other stuff I read. Okay, even if they want to provide their managers appropriate incentives, investors may not have the ability to do so. For one, they may not be able to penalize a manager who follows the herd into disaster. Okay, so there's that. And then lastly, guys, let me see if this was the last. Yeah, this is the last page I just wanted to show you. So it talks about prudential supervision, who should be supervised, and he mentions here there's no public policy rationale for protecting sophisticated investors despite their aura. Few hedge funds are large enough to pose systemic risks. However, there may be a macro-prudential rationale because funds may herd on some trades, causing both large asset price movements as well as demands on liquidity when trades are reversed with potential systemic consequences. So anyway, guys, so that's what I kind of wanted to show you guys. So that was the last piece. There wasn't anything else that I wanted to show you. So again, what's the takeaway, guys? This is just something that you got to file away. You got to kind of stick it in the back of your head and realize, when I hand my money off to somebody, this is what's happening. Not only that, but when I'm involved in the markets in general, even if I don't hand my money off to somebody, I try to manage it all myself. This herding effect can still affect me because of the way that it can move and fluctuate markets by detaching from fundamentals. So anyway, guys, got to do your own research. This is just me kind of fascinated with this topic. So apologize for the fire hose. Would love to hear what you guys think about it. Would love to hear what the reaction is on this. If you guys have read the Rajan paper, would love to hear your thoughts on it. Would love to hear your thoughts on Inside Job. I feel like we're headed for a new Inside Job here any day now, but I've been saying that for like 9 years. But what Rajan talked about in the 05, that's when he published this, I think it was November 05, what he talked about in that paper came true within 3 years, give or take. So there's a lot of prudent lessons and insights in that paper that I think are worth taking note of today. I mean, I don't think anything or much of anything has been done to protect against this effect, or if anything could be done. It's more of like a human nature thing, right? So can anything be done about it? Can anything be done to regulate it? I don't think so, right? It's just, I think as an individual investor, someone who's in charge of your family's finances or your own finances, you just need to be aware of this, and you need to go in clear-eyed. And if you don't like it, if it doesn't feel right, you don't go in at all, right? You got to find yield, and you got to find ways to do things elsewhere. Okay, guys, so thank you so much for joining me on a Friday evening here. Really, really appreciate everybody supporting the channel, everybody who's subscribed, everybody who's commented, everybody who's liked videos, shared videos. Can't tell you how much I appreciate it. It means a lot to me. Thank you, thank you, thank you. If you haven't subscribed yet, hit that subscribe button below. Hope everybody has a great weekend as we head towards, amazingly, the last 2 months of the year. We'll be back with you guys real soon with some new videos. But until next time, thank you again. Have a great weekend, and good night.